Gold is seeing is that the U.S., so we're looking at the dollar price of gold. The U.S. is becoming insolvent. Debt and deficits are out of control. The Fed can't raise interest rates to fight inflation. They panic to lower interest rates. That's less competition for gold, which pays no interest. It pushes more people into that hedge. Imagine if the Fed's balance sheet goes to $20 trillion. $30 trillion. And you don't want to own gold? Bitcoin can go to $63,000 a unit. And then why can't gold go to a few $1,000s an ounce? I don't know why I went down this road. You have to forgive me. But, gold, AU, comes from exploding stars. And it's an element in the Earth's crust. It's very limited. And you can't create any more of it. It can't be created.
Conclusive evidence shows that during the period U.S. national debt ballooned from $5 trillion to $35 trillion, gold prices have risen by 10 times since 2000. That's a whopping gain of over 826% since the beginning of the century. But here's where things really start to get interesting. If history repeats itself, gold prices could reach $5,000 an ounce when U.S. debt hits the $70 trillion mark. Based on long-term economic trends, MichaelPento predicts that nominal interest rates will need to be lowered because the government can't afford the rising costs of debt. Given gold's rarity and resilience, he stresses its value over cryptocurrencies, urging investors to consider gold as interest rates fall. Gold outpaces Bitcoin ETFs and stocks amid geopolitical risks. Reflecting on past economic shifts, Michael notes that the U.S. once tied its monetary policy to gold until 1971, when this was abandoned, triggering economic challenges. To gold's credit, it did a good job. During the 1970s, gold rose from just under $300 an ounce to nearly $2,600, a monumental 700% increase and more than enough to outpace raging inflation. Raising alarms about inflation, Michael warns that the U.S. dollar is on the same destructive path as other fiat currencies. With the Fed's balance sheet skyrocketing from $800 billion to $9 trillion, he predicts further devaluation if it continues to grow. Now we present the clips of MichaelPento's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I don't live in the world of overbought or that's a short-term thing. I just look at the secular trends of the economy. So the secular trend of the economy is for nominal interest rates to be lowered. And like we started out, your first question, the Fed understands that the government can't pay $1 trillion in interest in debt. So they're going to have to get short-term and long-term rates lower. So if nominal rates are down, they do that by printing money. And that means real interest rates rise. So gold could be in a secular bull market that's just beginning. I don't care if it's overbought. I don't care if it pulls back 10% or 15%, 20%. I don't care. I mean, it's not nice to see. It's not going to make me happy. But I'm looking at long-term secular trends, and the trend is much higher, in my opinion. And I never thought that, when I was a kid, I first got in this business in 1991. I never thought we would let this happen. We were supposed to be a country that tied our monetary policy to gold. That was destroyed completely in 1971. I'm old enough to remember 1971. I was only 8 years old, so I wasn't watching Tricky Dicky back then and closing the gold window. But I remember how terrible the 70s were because of gas lines and everything. My father had to get up at like 4 o'clock in the morning to sit on a gas line to get an odd and even license plate number to get gas. Do you remember that, Elijah? How old? Come on. I don't think you remember that, but I bet your dad did.
No, that was before my time.
A little bit, right? He's like, what is he talking about? But inflation has destroyed every fiat currency throughout history. And unfortunately, the United States is traveling that same road because our balance sheet, the Fed's balance sheet, which is called high-powered money, was zero before 1913. But from 1913 all the way to 2007, it took them all those years to print $800 billion. And from 2007 to 2022, that $800 billion went to $9 trillion. Zimbabwe would almost blush. $9 trillion of high-powered money, which is, well, why do we call it high-powered money? Because it's physical currency and coins in circulation plus Fed credit, which is the building blocks of all money. It goes into the banks, and the banks use those reserves to create loans and to buy bonds and to expand the money supply. That happened in the United States. That happened. And unfortunately, I think it's going to happen again. And imagine if the Fed's balance sheet goes to $20 trillion, $30 trillion, and you don't want to own gold. I mean, I don't use curse words, I try not to do that. But I'll just say, I'll call it Bitcoin. I'll be kind. Bitcoin, if Bitcoin can go to $63,000 a unit, then why can't gold go to a few $1,000s an ounce? Because, and I don't know why I went down this road. You have to forgive me, but gold AU comes from exploding stars, and it's an element in the Earth's crust. It's very limited, and you can't create any more of it. It can't be created. Okay, it's beautiful, and it's virtually indestructible, and it's extremely rare. However, cryptocurrencies are based on blockchains, which there are unlimited numbers of blockchains that can be created, where this ledger, digital ledger, where a coin can ride along. So they're not unique. I don't care if there's 21 million units of Bitcoin, because there's thousands of cryptocurrencies that trade that do pretty much the same thing, right? I'm finished with my diatribe there. Go buy yourself some gold. And listen, I don't sell gold. I'm just saying that if you believe, like I believe, that real interest rates are falling and nominal rates will be capped because the government is insolvent and they can't afford to pay interest on the debt, which is why Mr. Powell lowered interest rates in the first place, then you need to buy gold.
During the interview, MichaelPento predicted that further rate cuts could cause long-term interest rates to spike, damaging real estate and the stock market. He expresses concern that massive quantitative easing could lead to hyperinflation and warns that there is no simple fix to the current economic challenges. Wall Street celebrated the Federal Reserve's half-point rate cut last month by sending stocks to fresh record highs, but the blockbuster jobs report on Friday has caused doubts to creep in. Analysts at Bank of America and JP Morgan, one of the few banks that correctly predicted the half-point cut last month, have lowered their expectations for November's policy meeting. They now see a quarter-point cut instead of another 50 basis points. For instance, veteran market prognosticator Ed Yardeni told Bloomberg Friday that the earlier half-point cut was unnecessary and no more cuts are needed, adding, "I assume several Fed officials regret doing so much." Technically speaking, Michael notes his bullish stance on Indian gold and silver, anticipating a breakout. He warns that the escalating corporate and government debt could soon lead to significant challenges. Let's get back to the interview.
This is the time when the time that the Fed is cutting now happens to be the first time in history we have a problem with inflation and we have an insolvent government. And the Fed's rate cuts were well telegraphed. So the longer duration bonds already priced in. The bond market has already priced in the Fed's rate cuts. When the Fed started cutting rates, the 10-year note was 3.6%. Normally, the 10-year note is about 5% plus. In other words, what I'm trying to say is that the Fed is cutting rates to get interest rates to fall, but they already fell, and now they're rising because Jerome Powell thinks that the fight with inflation is over. So everything that he's supposed to be doing to make the economy better is the exact opposite. So rates are rising. So mortgage rates will rise, and costs to issue debt will rise, and that's going to go against everything he's trying to do. So to wrap it all up, we're not in the clear just because the Fed cut rates by 50 basis points, even though I think he's an absolute moron for doing it. So the Fed funds target rate is 4.5 to 4 3/4 right now. If they can cut to zero, they can cut to negative, especially if we have a digital currency, a CBDC. They can cut to negative, negative 100% if they wanted to. They just say, put your money in the bank, and the interest we're going to charge you is 100%. You have nothing left, so you better not put your money in the bank. You better just spend it. So that's what they could do. I mean, I'm using hyperbole, but they can cut rates to zero. They have a lot of room left to go. But if they did that, Elijah, like I just said, what would happen to long-term interest rates? What would happen to commodity prices if they did that? It's one thing to cut interest rates to zero or to 1%. They cut rates to 1% in 2001 to 2002. And then they cut rates to 0% after, from 2007 to 2008. And then they cut rates to 0%, after COVID. They can do that. And they did it with ease because we had a deflationary problem, or at least according to the minds of the government, we had a problem. We can't seem to get to 2% inflation. If only we can get to 2%, because, 1.9% doesn't really work. The economy can't function at 1.9%. This is how they think. It's crazy. So, but now we have a problem where inflation And you look at this morning's, I don't know when this is going to air, but we look at this morning's ISM services report showed that inflation is a real problem for corporations. It still is. So the Fed can very well cut interest rates to 0% to bail out the stock market. They might not like the reaction because interest rates on the long end of the curve, which the Fed does not control directly, they would have to actually go and buy those bonds. They're controlling the money market rate by the Fed funds rate. They have to go some massive QE program to buy long-term U.S. Treasuries, which would be hyperinflationary. I'm not saying they won't do that, but they're not doing it now. They're supposedly doing QT, and you could have interest rates spike out of control, which would destroy real estate, would destroy the stock market. So I guess I'm saying there's no easy answer this time. But I'm long India, working out well. I'm long gold. I actually bought some silver recently. That's, I think that's on the verge of a major breakout. I own utilities. We own all kinds of things here because it's not time yet. My model is built, my inflation, deflation, economic cycle model is built as a timing tool. Just because it hasn't triggered me to get net short the market doesn't mean that I'll never have to get there. Because like you said, these problems are extant and they haven't gone away. They're only getting worse. The debt continues to pile up. Corporations are issuing more and more debt. If you look at total non-financial debt to GDP, it's at a record high. The government is insolvent, 720% debt to revenue as far as the Treasury is concerned. That is incredible to me. Our deficits are $2 trillion per annum in supposedly good times, right? In times of full employment. So there's huge problems that have just not they haven't come to the surface yet, but they're festering underneath. And when they come to the surface, it's going to be a huge, huge problem.
As the national debt grows, there are concerns about the long-term stability of the US dollar and the potential for inflation. Physical gold provides investors with a tangible asset not tied to any government's fiscal policies or debt obligations, offering a means to preserve wealth and protect against the erosion of purchasing power that may result from excessive government borrowing and potential currency devaluation. Given your insights on U.S. debt and monetary policy, how do you see the future landscape for gold investors? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.